Familiar with MJ? That's they call it alternative harvest. So it has to do with the marijuana industry. It's really been spiking up lately. Really has taken off. I don't play in that area, but it's fun to watch. Oil, small caps, and more technology. So you can see the sectors that are outperforming in the current market environment. I did this as of 9/4, so this was, just 10 days ago. Small caps, healthcare, technology. Those are the groups that are outperforming in the current market environment. So just by...
What's the symbol for that alternative agriculture?
Oh, the alternative harvest is MJ. All right, someone got a nugget, one piece of information that they can take home with them today. I love it. So one way is just to get access to what's performing. And you can look at the bottom of this list and see what's underperforming. You're going to probably see a lot of foreign funds, a lot of commodity funds are currently at the bottom of this list. So let's take PSCH, the top one here. It's the Invesco S&P Small Cap Healthcare, and just plot it against the S&P 500 just to see what it looks like, to validate that these are actually outperforming. And this is the chart. So I took that, put it into Fast Track, and the red line is PSCH, the green line is the S&P 500, and look at that relative strength line. That's a pretty impressive relative strength line.
How far of a look back are they using when they do this relative strength calculation?
They use different time periods. Again, not all of them are very forthcoming with their methodology behind these, but I believe the stock charts looks back over a year and then breaks it up into different time frames within that year and weights those different time frames differently. And I believe the ETFscreen.com site does the same thing, but their methodology could be very different. But generally, from what I can tell, as I said, they're pretty vague about their methodologies. From what I can find, it's about a one-year look-back period. So that's pretty good. You can see it's been consistently trending up. The relative strength line has been consistently trending up for most of the last year. So let's look at ETFscreen.com. So this is the results. This is how ETFscreen presents their results a little differently. You have the symbol, and you have the ranking based on different time periods. These are 5-day intervals. You could also select 21-day intervals if you wanted to get a bigger spread. But it shows you the trend of each one of these funds. Interesting, PSCH is at the top of their list as well. But then you have a host of other funds. They don't put the names on the list, so it's harder to tell exactly what they are unless you're familiar with them. But we've got online retail, financial technology, oil again. This is one of those innovation biotech funds, I believe. Some more oil, internet, small caps. So you can see we're getting the same sort of results from ETFscreen.com that we are from stockcharts.com. The other good thing about ETFscreen is you can't really see it here, but the lower the score, they change the shading of the green. In fact, if it gets way down, it turns actually to white. You can kind of see it right here. That 79.4 is a little lighter. So it gives a visual representation. When you see something popping up, coming up, you'll see it white and then see it starting to turn green. So it gives you a visual representation of up-and-comers. So how can we use this? Well, I'm going to use a pretty simple example. And let's create a portfolio with these top 5 investments. As I said, we have small cap healthcare, online retail, financial technology, oil, and a biotech innovation fund. So pretty diverse group of funds. And if we put it into an equally weighted portfolio, let's see what we get. So the red line's the S&P 500. The green line is the equally weighted results of those 5 funds. And you can see it's certainly outperformed on a total return basis, 53 to 20%, so it's over doubled the return. The standard deviation's a little bit higher, 4% versus 3.6%, or I'm sorry, 4.3% versus 3.6%, so certainly a little more variability in those returns. But look at the UI. The UI is actually less, 2.2 compared to 3.8. So what does that mean is a lot of that variability that we're seeing in this green line, a lot of that's upside volatility, right? Because there's actually less downside volatility in the green line than there is the red line. The UPI obviously is going to be higher. We've got a higher return and a higher UI, so that's going to be obviously a higher result. So we're getting better risk-adjusted returns for this line. And then the overall maximum drawdown for this one-year period is 9% versus 10%. Okay, so let's compare the two funds, the two portfolios we put together. This is our low volatility portfolio that we looked at earlier, that we created based on the Ulster Performance Index. This is the portfolio we created based on the relative strength rankings. And here's that S&P 500. So again, we said, so this was about 6% compared to 20 and 53, a little less. The volatility metrics were exceptional on this portfolio. And we said, well, how can we do better than that? Well, we can get up to here. Again, this may be more volatile than some of us like. These drawdowns can be pretty steep. So how can we create a portfolio? Well, what if we combined the two portfolios? So what I did in this purple line was I took 70% of, I'm calling it AAII, that's just that low volatility portfolio. And I took 30% of AAII2, it's just the portfolio I created to represent that relative strength ranking portfolio. And I've plotted that result here in purple. So we have an 18.7% annualized return, standard deviation of about 1. UI is pretty low, 0.6, particularly when you compare it to the S&P 500, which had a UI of 3.78. So it's about, what, a fifth or a quarter of, about a fifth of the UI. And UPI is certainly a lot higher. And so we're getting better risk-adjusted return. And you can see it's producing about the same returns, not during all time periods. Obviously, the S&P shot up during this time period, but it also fell quite a bit harder. But it's more consistent. It's got a more consistent, we've got more certainty in the return stream. And the maximum drawdown was 2.77%. So you can see how we can use these concepts of Ulster Performance Index and relative rankings and create a portfolio that matches our own personal tolerance for risk and desire for expected returns. Any questions on how we created these portfolios?
Right here.
Pretty good. Yes?
You select those ETFs, those top 5 ETFs back in August, back in June of 2017, or August 2017, or was that as of now?
That was as of now.
Back in,
So this is all, yeah, so we have the benefit of looking backwards as we always do, right? But as you see some of those funds, you can see some of those funds have been up on that upper rank for quite a while. And as you see some of those ETFs start to fall off as their relative ranking score starts to drop, you can replace them with ones that are starting to come up to the top. And so it's definitely an active approach. It's something that you wouldn't want to put on autopilot. But some of these relative outperformers tend to outperform for quite a bit of time.
Have you gone back a year and taken what was the top 5 at that point and plotted those?
No, well, on ETF, I like to use the etfscreen.com rankings. I think they do a little bit better job. I can't get back quite a year, but what I have here is, I don't have it with us, but we could certainly look at how that's performed over the last, couple weeks. And we could go back. I haven't done that for today's presentation. We could go back and look at that. But as I said before, some of those funds, we'll go back here, these have all been in the 90s, at least since, June. So what I said is these relative outperformance tend to be outperformers consistently for a period of time. And when you see them drop off, they drop off pretty precipitously, and then you can replace them with what's coming up to the top.
So it's that dropping off pretty precipitously that kind of worries me. And, for example, this low volatility fund in a rising interest rate environment, wouldn't that start performing much more poorly?
Well, yeah, you're talking about this yellow line, correct?
The
low volatility.
It's yellow.
Yeah, the yellow or orange or whatever that is. Yeah, these low volatility portfolios, when I was talking about dropping off precipitously, I was talking about the ETFs that we pulled from the relative performance ranking. These funds tend to have high trend persistence, high day-to-day serial correlation, so they tend to trend in one direction, and when they turn, they tend to turn actually pretty slowly. And you can see, and you can use moving average timing techniques. You could use a 50-day moving average, for example, to give you an indication as to when that trend is changing. So when I talked about the precipitous fall off, it was not about this piece. I'm really not concerned about this piece. It's when you get into some of the more volatile ETFs that you want to pay a little more attention on a daily basis or weekly basis, depending on your approach. Yes?
You have to be very active in managing a portfolio like this. So how active do you have to be? How often is one normally changing the mix portfolio?
So the question was, how active do you have to be to manage this type of portfolio? Well, let me ask you a question. How often do you monitor your investments, your equity investments today?
Well, in a way I look at it, God, probably, say every day.
Every day? Okay.
Well, yeah, only because, say I have all my stuff, say in Quicken. So
Yeah.
I kind of look at it and, say updating it.
Right. So if you're already looking at it on a daily basis, I mean, that would be very appropriate for this. If you're someone who's looking at it on a weekly basis, we all know the market has its ups and downs, right? And so whatever you're comfortable with, I certainly propose, actively monitoring our investments, so in case the market does turn, that we can get out of harm's way. But if you're someone who's more of a buy and hold, then you're probably going to look at it less frequently because you're probably used to riding those ups and downs of the market. But if you're an more active investor, which it sounds like you might be, you'll probably want to look at it on a more frequent basis.
So a monthly or quarterly would not work in this situation?
Again, it depends on, these are personal questions. How comfortable are you investing in those types of investments and holding them? You could probably look at, these things on a weekly basis and start to see them change. Start to see those 90s go down to low 90s to 80s. You'll start to see them fall off, and as you see that, you can upgrade those. Do you have to do it on a daily basis? No, you don't have to do it on a daily basis. Again, that depends on you, your personal level of comfort and your tolerance for risk. Yes?
If they're averaging over the past year, these rankings aren't going to change that fast, are they?
Well, again, I said they're looking over a one-year time period in total, but they take it. So I'm sorry, the question was, if they're looking over a year, these rankings aren't going to change too frequently. So they're looking over a one-year time frame, but they're weighting different time periods within that one-year time period. So they may give more relevance to the more recent time period. So they may take a 30 or a 30-day performance metric and give that a higher weight in their overall calculation. But they are looking back over a whole time period, but then chunking that into different smaller time periods and giving more weight to, I know in ETFscreen.com, I believe they give more weight to the recent time period.
But even a 30-day period, you're not going to do any good looking at it every day.
Yeah. This is, again, it goes down to your personal level of comfort. So I've got a couple more slides here. Let me try to get these in before 10:15, and then if we have time, we can address a few more questions. So this is the same chart up on top. I've just put all the metrics that we were looking at in a matrix at the bottom, just a different way to look at this. I've highlighted in red the metrics that were the bottom performers, and in green those that were the top performers. So you can see the S&P was the bottom performer in 3 of the 5 categories. The low volatility portfolio was the highest performer in 4 out of the 5 categories, all except for annualized return. And then the portfolio, which I think probably is relevant to me and probably to a lot of you in here, actually was at the middle of the road. So what I take from this is don't look at the quantitative metrics by themselves. Don't just look at the quantitative metrics and say, okay, this is what I want to do. Always plot the chart. Take a look at the chart to make sure it's something that you want to invest in. And then lastly, I thought I'd end with this risk-reward chart. Again, this has our money market and the S&P 500, and then I've plotted our low volatility portfolio and our ETF screen portfolio along with our 70-30 portfolio. And you can see, going back to the concept of better risk-adjusted returns, this is a better risk-adjusted return. We got about the same return for what, about a third of the overall volatility. And if you wanted to juice that up, you can always play with the weightings. If you want to do a 60-40, or if you wanted to do a 50-50, you can see that line is going to go all the way up here until we get to, right, 0-100. And conversely, if this was still too much volatility for you personally, you could even notch that down and go 80-20, 90-10, and you can see you would end up back here. And so you can extrapolate and see where on this line you might want to reside. Again, we have all the choices of where we sit on this risk scale. We just don't have the control over the annualized return. So any other questions before I wrap up? Back there.
I got a question. One, what tool did you use to generate the combined portfolio screen?
Speak up, I couldn't hear you.
What was the tool that you used to generate the combined portfolio screen that you showed?
Oh, the 70-30?
Well, the screen where you combined
Oh, this one here. Okay, so the question was, what tool did I use to create this portfolio of 5 ETFs? Is that correct?
Yes.
Okay. So I have a tool. It's a proprietary tool that tacks on to Fast Track that can combine those things. There are tools out there you can use. I know, I believe stockcharts.com has a tool that you can create your own, what they call index, but you can create your own portfolio by putting in different symbols.
The second question is, what do funds like the inverse fund SH invest in so that they can pay you when the market goes down?
Okay, so the question was, what do the inverse funds invest in so that they can pay you when the market goes down? Right, so how do they get that inverse performance? I believe most of those inverse funds are created through derivative products. So they're using derivatives to track the negative performance of that. Another way to do this, I don't think they do it, is you can just short the S&P 500. You can actually sell short so that you benefit when the market goes down. But most of them are using derivative products.
Yeah.
Question here.
What do you think of like low volatility stock funds, low beta funds like USMV or SPLV? They invest in, low beta stocks to like reduce the volatility.
So the question was, what do I think of low volatility funds, low beta funds? My suggestion would be to plot that chart and take a look at what it looks like. You might be surprised at the results. There's still a level of volatility, so take a look at that fund, plot it, and make sure that the level of volatility corresponds to your personal tolerance for risk. I don't use them. I think I can create a lower volatility portfolio using some of the tools that we talked about today. So I don't have much experience with them.
Right, yeah.
Question here.
I've got two other areas of risk I'd like you to address. One that concerns me is credit risk today, and the other is interest rate risk. So where would you put your money, your cash, to get short duration, low credit risk?
The question was due to potential credit risk and interest rate risk, did you say? Where would I put my cash to get a reasonable return? This would be a great example of a very low volatility. The volatility metrics of that portfolio right now are very much like a money market fund, but they're returning 5-6%. Now, the difference between that and a money market fund is that this could go down at some point in the future. So if you were willing to monitor it, this could be a viable option for you. If you wanted to just park your money and not really have to think about it, unfortunately in this current environment, I don't think there's a lot of great options. There are options, but there's not a lot of great options. With interest rates being so low, you're just not going to, look at the annualized return on this money market over the last year is barely over zero. So look for opportunities that, we took a very small step out on this risk scale here and really increased that return from, just over zero to about 6%. That's certainly one possibility. But there's also, an alternative to that is there's a lot of ETFs out there that are very short duration bond funds. GSY, I think, is one of them. Mint, M-I-N-T, is another one. So there's some short duration funds out there that are trending up at maybe 3-4%.
Wouldn't you just put it in short-term treasury?
You could do that as well. Yeah, and there's laddering strategies, laddering bond strategy. If you were holding the bonds till maturity, you take away some of that interest rate risk, but you still have the credit risk associated with that. So, Pat.
Okay, when you do a scan with ETF screen or stock charts, are they taking into account risk, or is it just trend strength?
They're taking into account relative performance. Right? So relative performance has nothing to do with risk. So it's relative performance compared to the universe that they're comparing it to. So if ETF screen is comparing a particular ETF to the ETF universe, where does it fall? Does it fall in that top 10 percentile? The next 10?
Have you ever seen anybody have a scan that normalizes it to Ulcer Index or UPI or anything like that?
I have not. No, the question was, have I ever seen anyone with a scan that normalizes it to the UPI or the Ulcer Index? And the answer is no, I haven't seen that.
Or volatility? Or...
No, I have not. So.
Time for one more question.
One more question. Right there.
Yeah, I was wondering, like, portfolio like that, would you need to put any kind of stops in or anything like that, or just let it run?
Which portfolio are you talking?
I mean, if you had these 5 stocks, the combination
Yeah.
of everything,
So the question was, do you need to put in stops for a portfolio like this or even this? Yeah, I would always encourage you to, at a minimum, put a mental stop in, so that if it crossed a certain level, that, you know, you take the emotion out, it crosses a certain level, that you are going to sell and move to the safety of cash, or move it into another investment that is outperforming. So mental stops are always very important. So anyways, thank you for giving me the opportunity to speak to you this morning. I appreciate that. And again, reminder, if you want a copy of the presentation, please fill out one of those forms. You can either leave them up here or on that table out there. I'll check both of those before I leave. Thank you.
Thank you, Rob. Thank you. We'll take 15 minutes and come back and we'll hear Dr. Sohn.